a common sentiment amongst investors to perhaps believe all equities have become a little too expensive. In reality, equity appreciation has been largely centered around U.S. large cap stocks, and small caps are actually trading at their historical 20-year averages. Fidelity Global common sentiment amongst investors to perhaps believe all equities have become a little too expensive. In reality, equity appreciation has been largely centered around U.S. large cap stocks, and small caps are actually trading at their historical 20-year averages. Fidelity Global Small Caps Opportunity Fund has seen strong performance in 2024, and our next guests, there's two of them, are here to share how their investing strategy is fueling its success. Joining me now to discuss their strategy and also to provide an update on Fidelity Global Small Caps Opportunity Fund are portfolio managers Connor Gordon and Chris Maludzinski. Hi, Connor. And we've got Chris joining us remotely. Glad to see you both, and thanks for joining us.
Great to be here.
Good to have you, Chris.
Yeah, thanks for having me, Pamela.
So I want to begin with each of you, and we'll invite everyone to send their questions in for both of you over the next half hour or so. Send them in. We'll put them to them, put them on the spot. It is a moment where there's a lot of discussion of international, and you spoke to us a couple months ago about your fund can go anywhere. That was part of the piece. It doesn't have to, but it can. Is the international story and international kind of places for opportunity, hunting ground, whatever you want to call it, looking more attractive to you? I'll begin with you, Chris.
Yeah, sure. Again, thanks to everyone for joining. So I think the good thing about Fidelity and managing a global fund at Fidelity is that we have 140 analysts across the globe that we can leverage, right? So this is a global fund, so by definition the U.S. is a big part of that at roughly 60%. But you have the other 40 that's looking more attractive as valuations have come down. Investor bases are kind of more pessimistic in a lot of international markets, especially given the recent volatility. So on the margin, we are spending more time looking at Europe, looking at Japan, trying to surface really attractive risk reward opportunities there. And it's a huge competitive advantage, being in the seats that Connor and I are managing a fund like this. Again, just given our global resources, we have boots on the ground each and every week, visiting management teams, going to conferences, going to trade shows, and really just doing that bottom-up research. As you noted, this is a very idiosyncratic fund, right? So we're 100% bottoms up. That's kind of what Fidelity is known for, that research advantage, getting that edge, and we're really able to do that with these international markets and the big analyst team that we have.
Yeah, fantastic. And we'll talk more and more about that. Connor, are you traveling any more or less, or at least meeting more or less because of the international story?
I'll maybe ask, just to add two things to what Chris said. And, I think in general, we're a global small cap fund, but we tend to think of ourselves more of a small cap fund that invests globally. So when we look at our global allocation, it's not a top-down view. It tends to fall out of, the sectors that we're looking at or the opportunities that we're looking at. So we don't necessarily see it as an asset class, we see it as an opportunity set. So just to give you an example, right? So an area that we've kind of spent some time over the last few months looking at is something like mining equipment, right? So that's, thematically an area that we're kind of interested in. And when you look around the world, obviously you have large mining equipment companies like Caterpillar, right? Large caps in the United States. But when you get outside the United States, you start finding these great kind of hidden, I call them hidden global champions, right?
Okay.
So in Sweden, you have companies like Epiroc. In Finland, you have Metso. In the UK, you have a company called Weir. In Japan, you have a company called Komatsu. So, companies that are kind of under the radar outside of those big S&P 500 type companies. But when we're looking at that opportunity, we might be buying an international company, but that's headquartered internationally but sells globally. Okay, and the allocation isn't necessarily a bullish view on a specific geography. It's we love this company, it just happens to be headquartered. And we're really expanding the opportunity set. The other thing I'd say is, we like to say that volatility creates dislocation creates mispricing. So what you've seen over the past 2 weeks, with the election or potential election coming up it's European elections a couple weeks ago, and the pending election in France it creates a lot of dislocation. So when we can expand that opportunity set, we get our shopping list ready, right? So we are doing the work now in case we have a Brexit type event in France in 2 weeks, right? Yep. We have a list of companies, we have price targets that we want to execute at. And maybe nothing happens, but we know that there could be volatility and we could get that opportunity to buy these great companies at great prices.
Yeah, it's fascinating. Chris, speak a little bit more, if you don't mind, to that idea of these companies are everywhere. They could be selling anywhere. They may be located somewhere. But just to kind of push that a bit, are you interested in the local story for some of these companies as well? They're smaller companies, so they would have a local presence and probably are selling locally. How much of that is of interest, and how much of that is part of the story?
Yeah, I think it comes down to, again, each and every set of expectations, right? So we're trying to find dislocations, mispricings, and to kind of bring it back to our strategy. Focus on high quality companies, right? So companies, again, that can grow earnings at above market rates of return, plus they have a multiple arbitrage, because we're trying to get paid both ways, right? The earnings growth and the multiple expansion. So it would have to come down to, okay, why is the company mispriced? Why is there volatility? What's the rationale for it to increase in the future? And it would be nice if the kind of opportunity set was larger, if they did have a global opportunity set, because again, there's bigger white space to grow, to buy down that multiple. But it really comes back to the starting point of the valuation and what the story is.
So tell us a bit about companies. You guys both use the word inflection point. You talk about that. You've just given an inflection point. There's a great example of political uncertainty, any kind of disruption. There's a catalyst there ultimately. What else is an inflection point? What should we be thinking about?
Yeah, look, I think our basic view is if you want differentiated returns, you have to do something different, right?
Than what's going on.
Than what's going on in the market. You have to see something different. You got to do something different than what is going on in the market. So we try to find situations, as Chris kind of highlighted, we're looking for these quality companies. But what causes a quality company to get mispriced are inflection points. So that is where we can form a differentiated view. And when I talk about differentiated view, imagine we have a stock and the market, the consensus, thinks that they're going to earn $1. Mm-hmm. We're looking for situations when we look out, we think they're going to earn $2, $3, right? Materially more than what the market thinks. So we're looking for inflection points like companies with new products, right? Maybe there's a new management team, an acquisition or a divestiture, or industry consolidation. It could be geopolitical volatility, right? That gives you the opportunity to buy these things. But in general, we're looking for some sort of change, because when things change, expectations change. And when expectations change, stock prices go up and down. And that's what we're looking for. Okay,
change, inflection points. Chris, anything to add to that?
No, I think Connor highlighted it pretty well. I mean, we talked about this in the past, but spinoffs is an area that we also pay attention to, because the small cap index in general. I mean, I can't stress this enough. It's very underfollowed, very undercovered. There's only a few sell side analysts that look at some of the names that we're invested in.
But and you cover it. For example, you cover it. That's the thing. It's undercovered.
Our team covers it. Yeah. Exactly. So we really get that edge, and especially when there's a situation like a spinoff, a lot of forced selling. So we can really do the extra work and uncover some really great opportunities, right? So there was an example like about a year ago today. A company was spun off, heavy selling, stock was trading under 4 times earnings, right? So really, the terminal value was written off the stock, but it had a great management team, and had a really great product. The question was, how long are they going to sell that product in the market for? So we're able to kind of have a differentiated view, and especially when there's no sell side research out there, it really creates great opportunities.
That's amazing. Let's pivot a little bit to they're not small companies. Some of them. How big are these companies? Give us the range.
Yeah, the average the market cap in our fund is about $7 billion US.
That's right? The average. So they could go down to even 1 or 2, and
exactly. So the rough range that we tend to work in tends to be that, call it 2 to 10 or 2 to $12 billion. It's 10 to 12 tends to be the cap. We go by the index. So when we're investing, at least 80% of the assets need to be invested in that range.
Okay.
So if you look historically, where we've generated the most alpha are in those, $2, $3, $5 billion market caps, right? And I like to say success for us are buying small caps and become large caps, right? That's success. I don't want to own small caps that stay small caps.
Right.
So, and I think to what Chris was talking about there, as more and more money has flowed into the S&P 500 and flown into passive investing products, there's a whole group of stocks underneath that get neglected, right? And when things get neglected, stocks get mispriced. And there are fewer eyeballs on these stocks, so that when change happens, people aren't paying attention. They aren't paying attention, right? And I think when we have those resources, those 140 analysts who are waking up every single day trying to find the next great investment opportunity, when change happens, we're on top of it, right? And that's where we've been able to find these great opportunities in that $2, $3, $5 billion market cap, where, in many cases we've had success. Now they're 10, 12, $15 billion market caps. So
Chris, so you want them to grow. Do you max out though? I mean, this is your mandate. What does your mandate say in terms of maxing out? If they get to be $15 billion market cap, what do you do?
Sure, there's no sunset clause, right? But the mandate says 20% can run above, I guess, the top end of the, called the Russell 2000, right? So that 10 to 12 that Connor was talking about. At a certain point, if every single stock that we own is winning, then, we're going to have to recycle that capital down into, that $3 to $5 billion range, right? And hopefully we find more winners over time, right? But it's a fluid process. There's turnover in the fund, so this is never an issue for us. It's just part of the kind of daily management of the fund.
Yeah,
and I think
it's called a good problem.
I would add, I think in general, many people often think small cap sounds risky, right? And what we've been talking about is, these are not junior mining companies or oil and gas companies. These are, like what I said, called hidden global champions, right? Businesses that sometimes you don't even, you might be using their product, and you might not even know they're a public company, right? Because they're either, they're headquartered in the United States or they're headquartered somewhere in Europe. But we're trying to find these businesses that are profitable, proven, have demonstrated profitability and demonstrated business models. We're not trying to find the $100 million company that's speculated that might be $1 billion or $2 billion down the road. We want companies that have already hit escape velocity, but still have a lot of growth runway, right?
So, okay, interesting. I want to kind of use that to back into a bit of a macro discussion, which I know neither of you want to have. So, but in any case, the whole idea of what interest rates coming down means to a smaller company and what they can do with it. But more to the point, capital allocation for a smaller company is just all the more important because they have less and less to work with, so they got to do it right. What do you like to see? What's a great case scenario for capital allocation with interest rates where they are? Like, it's tough. It's tough going right now. Chris, we'll start with you. Like, what's an example of capital allocation? Yeah.
Sure. Yeah. No, a couple points on that, Pamela. Right now in the current environment, with all the hikes that we've seen over the last couple of years, we place a high emphasis on balance sheet, right? Because if the company doesn't have a strong balance sheet, then capital allocation won't really matter, right? They're going to spend all their time paying down debt, using all their free cash flow just to kind of repair what they've done over the last decade. So, there are a lot of, heavily levered companies in small cap land. And I think the knee-jerk reaction of the overnight rate, potentially coming down is, I guess that's good for the asset class. I guess what we want to stress is that there's been a lot of companies that have engineered their balance sheet for low interest rates over the last 15 years. And as we roll forward, that debt over the next few years, there's a lot of companies that are going to have, a lot of trouble as those rates roll. So again, that's why we place that high emphasis on a strong balance sheet, because the companies that have that strong balance sheet are going to be on the front foot, and they're going to be able to, again, invest and steal market share on the other side. So what we look for, again, is just high incremental return on invested capital and high, future earnings growth. And, the companies that, again, have that good management team and that strong balance sheet will be able to do both.
Great.
Yeah. Well, maybe just add, so, when we talk about inflection points, inflection points can be structural, they can be cyclical, and they can be idiosyncratic. So when we think about structural inflection points, maybe there's some sort of new technology or change in consumer behavior or maybe even regulation. Mm-hmm. Cyclical is obviously supply-demand driven, and then we have the idiosyncratic, new management and new products, et cetera. So one thing that we're looking for, right, and what's a dream scenario for a small business, right, okay, would be a company that has a very large end market with a better mousetrap, right? So think of this, and and incrementally, you're just taking market share from incumbent players that aren't competitive. Companies with new again, why do we look for new products? Companies with new products that might be creating a market, right? Nice. If you think of, and this is obviously a big example, but a company like Apple, right? They have created multiple markets. Who knew you needed an iPad, right? Yeah. When if you remember, that product got made fun of when it got launched, right?
Do we need an iPad? But in any case, we buy them. It doesn't matter.
But right, so and then ultimately, what we're trying to find is, as Chris said, companies that have a proven business model, profitable business model, high return on capital that can reinvest. So a company that we own in the fund. And retailers are often a great example of this. So a company that we own in the fund is Valvoline. So Valvoline is a quick lube operator, right? You need to get your oil changed. They do your oil change. So they roughly today, great business, high margins.
Everyone needs to
use their motor oil, right? Yeah. And if you think about it, they are roughly single digit percentage enormous market, right? You think about how many 100 million cars there are in the United States. You need to get your oil changed a couple times a year. It's pretty non-discretionary. Who knows? Are you that price sensitive when you need to do it? Not really. But so all of a sudden, who are you competing against? You're competing against mom and pop operators.
Okay.
So they just have, they have a better customer experience. They have, online, online booking, online experience. They can turn your car around faster, right? So instead of you dropping your car off for a couple hours at the dealership to get your oil changed, well, guess what? You're in and out of there in like 20 minutes. Right. So over time, they're just taking share, and they are opening more stores, and they have a very, very long runway to continue to compound capital at very high rates of return. So that's something, that's why would we own something like that? Is okay, great box, great economics. They can continue to roll that out.
Okay, Chris, maybe I'll punt this same example to you. What would be a great example of that company doing capital allocation? I mean, would it be to dump money into AI, for instance, to get even better at the scheduling, for instance? I mean, what's an example of a small company? Is it all AI? Is capital allocation right now just all AI?
No, I think AI gets a lot of airtime, and probably undeservedly so, right? I mean, it depends on your business model. I mean, in the consumer sector, if you're a retailer, like really, what can AI do for you online? I guess there's some optimization, that you can do to drive sales there. But on the brick and mortar front, right? Maybe you have a little bit better inventory management. You have, you're better able to respond to consumer demand. But I think that the winners are a bit more high level than that, right? It's like, do they have a good product, and is there demand for that product? And do they have a lot of white space? Can they grow their earnings at above market rates of return for a long period of time? So again, AI is probably getting an inordinate amount of the discussion today, but we're focused on kind of the winners that are going to either benefit more or less from AI. It's not really a huge part of our investment process.
Okay, exactly. I want to pick up on that. I was actually kind of leading into that, hoping that you'd say that. So is it AI has a few mispriced probably pieces of the story out there? Is that useful for you when you're investing? Like, let's say, this company's got a massive valuation because AI is going to change everything, and it's just, but actually there's then a realization that maybe it went too far?
Yeah, I'd say like the reality is there are barely any ways to play AI. If you just think like what products are out there. We probably all played around with an LLM like Claude or Perplexity, but there aren't that many applications for consumers at this point, or enterprise, right? I think if you look back, and this is going back very, very far, but if you look back over the last 200 years of technology transitions, okay, and we're talking things like canals, railways, electricity, oil, automobiles, mainframe computers, PCs, internet, right? The transitions take a long time, 30 to 40 years, right? And just imagine you logging onto your Netscape browser in 1995.
I wasn't around then.
Okay, well, what the internet was versus what it's become today, right? And in general, when we're looking at AI, I think the reality is it's very hard to pick the winners. That's one of the big lessons. A, it takes a long time for technology to transition. B, it's hard to pick the winners because the winners don't exist yet. Right?
So you're going to do other stuff.
There's going to do other stuff. So, I think over the next 3, 5, 10 years, there will be winners created, and they will go public, and there will be opportunities to invest in them, but they don't exist today.
Okay.
I guess the third lesson from, if you look over 200 years of technology history, is it's very easy to predict the losers, right?
Right.
As soon as you were think of newspapers, right? Think of fax machines. As soon as you were on the wrong side of a technology transition and you were obsolete,
you need to short it.
Yeah, well, I mean, if you could short, but we want to avoid it, right? The trap that many investors fall into is they become value stocks, low PE stocks.
Right, totally, yeah.
And the problem is they're low PE stocks because the earnings are going away, right? And so we want to avoid the value trap. So when we have exited a few positions that were in the portfolio that we actually think are at risk. So okay. I think for us right now, the focus on AI is, okay, which of our companies might be at risk? Terminal risk, right? And then on the flip side is, there's some very, very interesting, companies that are out there that are using some of this technology to really improve their cost structure.
Perfect.
right? So which companies can get more efficient, can get more profitable by using technology to really improve the normalized earnings power of the business. That's what we focus on.
Fascinating. And Chris, just sort of take us inside the fund a bit. I mean, you've got some positions that will be companies that are trading at, if I remember this correctly, and what you've shown us, like 6 times earnings, and then the others that'll be trading at 25 times earnings. So, I mean, what gives there? What are you doing there?
Yeah, so it's all about relative valuation, right? And kind of coming back to what we said earlier, it's about, the set of expectations and, why is the market wrong and why is the market going to come around to our view, right? So if you're looking at a company, to Connor's point, that's maybe 4 times earnings, terminal value risk likely, or, not a lot of growth, bad balance sheet, maybe a lot of these companies, but if we're investing in low PE stocks, it's because we don't think the market has the right view. They generally have a stronger balance sheet. They generally are high quality companies that generate a lot of cash. And again, to our point earlier, they can use that cash to improve the business, going forward. So, it's, shopping in, low PE multiple stocks can be extremely profitable if that story is getting better, right? Because that multiple re-rate can be very powerful. And then, I guess on the flip side, when you're looking at companies that are trading at 20 north of 20 times earnings, and they have a lot of growth, and they generate a lot of cash, well, they can buy down that multiple pretty quickly, right? So again, it's just like, 20 times earnings, but it might be worth 25, and why is that the case? So that's kind of what we spend our time thinking about.
Some great questions coming in about the example that you just used a few minutes ago about having to change your oil and so on. So advisors asking, what was the opportunity that you saw before you took your position, for instance?
Yeah.
That goes a long way to sort of what you're doing.
Yeah, again, so inflection point, right?
Yeah. Okay.
So if you think, most people when they think of Valvoline, they think motor oil. The motor oil that you probably buy at a shop.
Right.
And for a long time, that's what it was. So if you look at the split of business, when we were initially looking at this business probably 5 years ago.
But you just launched the fund recently.
Well, we've been running the strategy for institutional clients since 2019. Okay. So, the Valvoline was, call it, I'm going to get these numbers wrong, Chris will correct me, but was 65% motor oil. And then you had this quick lube business that we were talking about earlier that was like 30-ish%. And people will look at that stock and say, this doesn't look that interesting because the motor oil business, it's not growing. And it wasn't.
Commodity.
It's a commodity.
Yeah.
You got a lot of competition. It's not growing. And it hadn't grown. But we had this quick lube business that was growing at that time. They were growing their revenues 15, 17%, and profits were kind of growing at 20. So you start doing the math, okay, 30%, but growing 20% a year. And it was 30, 40. And all of a sudden we hit this inflection point where we thought, okay, it's going to become more than 50% of the profitability of the business, and that is going to be the incremental driver. And we also, so that was kind of the genesis of the idea of it, and that's how our inflection point lens comes on top of that. And then we had this idea that said, in speaking with the management team, it became clear that strategically, they didn't need to own the motor oil business. So we thought, could they sell it? Could they spin it off, right? And at that time, ultimately what happened was Saudi Aramco came in and bought the motor oil business.
So that's exciting,
right? For $2.65 billion, right? Which is a big number for a no-growth business. And then all of a sudden, what were we left with? We got rid of the bad piece, the less than desirable piece, and we were left with a pure play. Right. Automotive services business, right? And we got to buy that at a low multiple. But you have to look forward, right? If you had looked at the numbers, they didn't, it wasn't necessarily amazing, but you had to look forward. You had to see something different, and that was the inflection point.
And that's the power of your research. Chris, tell us a little bit about where this fund fits. You've said before this is core. And there's a question here that I think will kind of fit with this, if I can put this to you. How does this fund compare to Fidelity Global Small Cap Fund? Take us there.
Okay, yeah, maybe Connor can talk on the Global Small Cap Fund after.
Tell us about core. Look,
I think we're a great complement, right? If you look at where we invest, the sectors that really represent the bulk of the fund, it's consumer, it's industrial. There's some insurance in there, there's some real estate in there. not a lot of technology in there, right? And we're U.S. in North America, but we're also ex-U.S., right? So we have some international exposure. So I think that we're a great complement to advisors' core portfolios right now, which are generally heavily overweight U.S. and heavily overweight large cap technology stocks, right? And those technology stocks, again, like they're great businesses, but I remember when a lot of them traded at 10, 11 times earnings. This is going back 10 years ago, and now they've re-rated to between 30 and 40 times earnings, right? Wow. So I think that if you look at our portfolio, at the multiple that the portfolio trades at, and the businesses that we own, it's a great complement, I guess, to what investors are overweight today.
That's a bit of a wow, that statistic there. Okay, we'll take this to you. So differentiate it for us.
I'm not going to speak specifically about other funds, but I think in general, that fund is...
You're all friends.
Yeah, look, it's significantly more diversified. So going from memory, I think it's probably something in the neighborhood of 150 or 200 stocks, right?
Okay.
And it tends to be run more country neutral and sector neutral. So I think, less tracking error to the benchmark, and think of it as more like index plus. One of the reasons why this strategy was created was to go out and build a best ideas portfolio. So think of this as higher tracking error, 40 to 50 stocks, kind of the bulk of the value.
You're describing your fund.
Our fund.
Yeah,
this is our fund.
Yeah.
So we are trying to go out and find the best ideas, regardless of where they happen to be headquartered, with a lot fewer constraints, right? Again, we don't look at this as an asset class. We look at it as an opportunity set, and we want to expand that opportunity set and then focus in on the best ideas.
Okay, fantastic. Final question to
Pamela,
you, Chris.
if I could just add
one
more on that. Yeah, so just like fleshing out the small versus large. I mean, if I look at the S&P right now, I think we're 21 times forward earnings. A lot of momentum, obviously, in the large cap space. And then you look at our index, and we're at 16 times forward earnings. So 25% discount with similar forward earnings growth expectations. So from an asset class perspective, it's a much more attractive kind of hunting ground for higher future returns is the way I'd frame it.
I think we just end it there. That was a pretty good notion, John. I was going to ask something else. Well, I will ask you this. Okay, so to both of you, it's not growth, but you would say you're aligned with growth. I mean, you're not looking for companies that are not growing, but just speak to sort of that idea of how people might think through factors, which you don't like. But are these growth companies? Like, would you say that?
Look, I think there's a difference between Chris and I are both value oriented. But there's a difference between being value-oriented and being a value investor, right? So we're always thinking about what is the intrinsic value of a company, and then we want to buy it at a big discount, right? We want to buy that, what's mispriced. But, we like to say if you run a DCF, like discounted cash flow analysis, value is a function of growth, right? You can't separate, Buffett always says that, you can't separate growth and value. They're joined at the hip. So when we're looking at things, and that kind of goes back to why we own things that trade at 25 times earnings, why we own things at 6 times earnings. The value of a stock is just the discounted value of all the cash flow it's going to generate. And we can buy that at a discount. A stock trading at 6 times earnings can be a discount. Stock trading at 25 times earnings can be a discount. And what we end up having is balance. We talk about balance a lot in the portfolio, right? We didn't talk a lot about portfolio construction, but that's what we do. We want things that are very, very balanced, and we end up being very factor neutral, but also kind of a little a bias toward quality, a little bit biased toward growth, but in general very, very factor neutral.
Okay. One final thought, Chris. Anything?
No, look, I mean, coming back to my previous point, it's just a great alpha-rich asset class. And, we have a co-managed fund, which is unique at Fidelity, plus 140 analysts across the globe that we get to leverage. So, we're excited to wake up each and every day to find those new opportunities. Really
exciting to hear the update of how the fund's arranged and what you're doing with it. And we look forward to checking in with you again. Thank you very much for joining us, Chris and Connor.
Thanks, everyone.